Joyce, let me just begin with you. And it's interesting. I wonder if all this talk of getting the economy back to normal more quickly actually takes some of the pressure off of Congress to pass this bill more quickly. What are your expectations?
No, I think Congress is going to pass this bill relatively quickly. I don't think this goes until the end of the week. And I think the steps that it's not just the Congress. I mean, what the Fed announced yesterday was extraordinary with respect to supporting financial markets and the economy. So the combination of social distancing, the market moves that we have seen, which have been, some of the biggest market moves we've seen as far as the drop in liquidity since 1929. I do think that you're going to see, the stimulus bill, the extraordinary action, and you could see some short covering from here, just given how quickly the market moved down over the last few weeks.
Sure. So your expectation is that bill still moves along pretty quickly here. The markets are looking for that. Joe, let me ask you about, again, if we're going to start to look towards normalization, do we start to look at what that means for the Fed? I mean, just yesterday, this whole new slate of programs and announcements came out. And do we start even talking about the unwind or no?
I think it's too early to talk about the unwind. I think that we're still in crisis mode, both from a monetary and fiscal policy standpoint. So hopefully the fiscal folks down in D.C. don't waste any more time, because the policy actions that they're contemplating are absolutely needed to get money in people's hands as quickly as possible. And on the monetary side, I think there's still a lot of healing that needs to happen within particularly fixed income markets, which certainly have responded positively to the Fed's actions over the course of the last several weeks. But there's still more to go. There's still lots of dysfunction going on in fixed income markets. And I think until you see fixed income markets settle down a bit and liquidity is at much better levels than it's been, it's tough to see where there's a bottom in equity markets right now.
Joe, it's David Faber. I'm always curious to hear what Neuberger's clients, obviously you've got people managing all the different teams there, but what are you sort of hearing in terms of, and what are you seeing in terms of clients and their sentiment, their desire to get to cash, or perhaps just stay the course?
So it's been an interesting contrast, David. I think, as you may know a bit about Neuberger, we serve both large institutions as well as individuals. And I think on the institutional side, there's been very active dialogue with folks around where the opportunities are that are getting created by the bit of a mess that we're in the middle of right now. And I'm talking about markets. Obviously, the health crisis is paramount. But as it relates to markets, I think, whether it's some of the dysfunction going on in credit markets or other parts of the fixed income spectrum, or in equities where stocks in some cases may have gotten, there may be overreactions. On the individual side, much more caution. Maybe not surprisingly, I think folks are still getting their arms around something that, while we've all been, you and your folks, the market participants have been living with this for the last number of weeks, the speed that this has occurred, I think, is still spinning the individual investor. So I think there's still a lot of fear out there.
Yeah, I mean, Joyce, I'm just curious what you're telling people, because it's March, so people are starting to get updates from their financial advisors and mutual fund advisors, and the quarter to date and year to date numbers look pretty ugly. I mean, down 25 to 30%. So what do you tell people when they ask you how much worse it can get?
Well, I mean, we are in a global recession right now, and we are expecting a contraction of the U.S. economy of 14%. And we're still in a period where, when you look at how long this has taken to play out in Wuhan, where they're reopening on April the 8th, I mean, you still have some weeks of this to go. Potentially, we're seeing the first signs of this peaking in Italy. So it's not just the market conditions. Everybody's going to focus on, when do we see the infection rate peak in the United States? So we're telling people that they need to be prepared for this volatility to be here for a while. That said, what the Fed has announced has been extraordinary with respect to supporting financial markets and the economy, and we do think that the fiscal stimulus will move forward in the Congress this week. You could look into a month end, though, and see some rebalancing risk here, just given how sharp the market moves have been. And we are looking at, potential inflows coming into the S&P 500, but we've seen market depth and liquidity drop more than 90% 4% in this marketplace. So it's hard to call the bottom here because we can't call the peak for the infection rate, and that's what markets are going to be looking for. We also think you're going to see a surge in the jobless claims, like 1.5 million, so that's also going to weigh on sentiment. So a lot of the questions ahead are how quickly can we get the fiscal stimulus into individual households, into small and medium sized businesses, and here is where we just have to see how quickly some of these channels can work as far as getting the fiscal stimulus to the sectors where they need it the most as we proceed with the social distancing.
Back to the real person at home and the real client of, for example, Neuberger Berman. You mentioned fear. When does that start to abate, in your opinion?
Well, I think Joyce makes a good point in terms of the trend on the health side and the virus side. So I think that will probably reduce the fear levels. I think markets stabilizing a bit. Our advice to clients has been to, look, we're in a deep recession. The numbers are going to be really ugly. Take the opportunity to very gradually rebalance. Don't rush to rebalance because there's going to be opportunities to add, we believe, at lower levels. The depth of economic decline and earnings decline are still all over the map, as you've reported. We have numbers that are -10 in the quarter, -20, -30, worse. We've seen equity EPS numbers for the S&P 500 at $100 a share, 135, 150. So it's telling you people have no idea, and I think when there's that void of information, as we all know, markets don't respond to that. So you'll see these ebbs and flows, and given the liquidity characteristics of equity markets, you may get squeezes on the upside as things bounce back, and there's some of that rebalancing. But I still think that until you get a sense of how deep the hole is, it's not a fundamental foundation to start rebuilding.
All right. Joseph Amato, Joyce Chang, thank you both for joining us this morning. We appreciate it.